Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. He's Jeff Sansoro, the voice of the people. Jeff, so I've got a statement and then a question. So the statement is, this is one of those bonus episodes, which means 33% less you and me.
Yes.
We have a great guest.
That is a correct statement.
And my question, before we bring our guest on, how was my read-in right there? Was that too hot on the mic, or was it good?
No, you nailed it, which is odd. I mean, normally we take like 3 or 4 times to do the beginning of the show, but that was good. You did a good job.
Thanks. All right. Thanks, listeners. I hope you enjoyed doing that intro as much as I did.
And by the way, this intro is why it's good to have guests on, because there's less of this nonsense.
Exactly. We're not even going to do the housekeeper. We're going to jump in. We're going to bring our good friend, Robert Brokamp, on. Bro, as he is known, is a real financial planning and retirement planning expert. It's been basically your life's work with the Motley Fool, your professional life's work anyway. Your actual life's work is a wonderful family that you have. You pay for it, helping people become smarter, happier, and richer. Bro, it's good to have you on.
Such a pleasure, gentlemen. Thanks for having me back on the show.
Well, now, I mean, one could quibble whether we're having you back on the show or not. You have been on,
but it wasn't technically this show. It was
That's
the
right. You've never been on Investing Unscripted.
It's great talking to you two in a podcast format again.
There we go. We go.
Absolutely nailed it. So you were on, it was early November of 2022. We actually ended up doing a 2-part show with a recording that we did with you. Part of it was investing with kids. The other part was investing for kids. So I encourage people to go back. We'll put links in the show notes for those episodes. I think it was a great conversation about investing in kids, whether it's your own kids or grandkids or whatever. I think it was really fun. But Jeff, we recently had a common connection on the podcast, Dan from 403BYs, that you brought on because of your experience in education and dealing with 403Bs for teachers. And it kind of went full circle where it was time to bring Bro back on, Jeff.
Yeah. I mean, that was a great conversation. It's another one people can go back and check out. It was only a few episodes ago, so you don't have to go too far back in the feed. But we got a comment on, might have been the YouTube channel, where someone said, this was a great conversation. Thank you. But what about all of us who don't have 403Bs? What about the rest of the retirement? So it got us thinking it's a good time to have Bro back on to talk all things retirement. So Bro, we were thinking of sort of bucketing the conversation around, I think probably like the bookends of retirement. We'll start by talking about how to think about it, how to set things up when you're new to adulting, at a college, first job, that kind of thing. You sit down with your HR department, you get the website for the retirement plans, all that stuff. And then later on, we'll chat about not necessarily being in retirement, but we will hit on that a little bit. But Jason and I want to have a conversation about, let's call it 5 to 10 years before retirement. Because every time we answer a question, it's from the perspective of people who have, let's just say 15 or 20 years ahead of us and before we'd have to start withdrawing from retirement accounts. And we do sometimes get people asking like, well, what about me? I'm 58 or I'm 63. So we'll have bookend conversations here. So I guess to start, Bro, let's just talk about what it's like to be a newly employed adult out of school, first job, assuming there's some sort of retirement plan. How do you advise people think about this? Where do you turn people to first in terms of getting all of that stuff set up?
First of all, hopefully you will have some sort of retirement plan. 401k, could be a 403b if you're going to be a teacher or in the nonprofit world. Could be some lesser known ones like a Simple or a SEP if you're working for a smaller company. But you want to sign up as soon as possible. Fortunately, these days, many, if not most employers, automatically enroll you. So that's good. The thing is, they will often automatically enroll you at a pretty low contribution rate. What most experts recommend these days is that you should be saving about 15% of your household income for retirement. And that could include the match. So I work at the Motley Fool. At the Motley Fool, if you contribute 9%, the Fool throws in 6%, you hit that 15%. Chances are, if you are being auto-enrolled into a 401k or 403b or any kind of retirement plan, you're probably not being auto-enrolled to a total contribution rate of 15%. So don't think that even if you are auto-enrolled, you're good. You should aim to be getting that. And I understand that many people who graduate from college, they may not be making much money. They may have student loans. There's no way I can contribute that much. Get as much as you can in and at least take full advantage of the match, right? That is, you put in a certain amount of money, the employer will put in extra money. It's like a bonus. It's free money. You should take advantage of it as soon as possible. Just start saving as soon as you can.
Bro, on the employer match, I want to spend a couple minutes talking about that because I think it's underappreciated how incredibly powerful It is not just this free money, but it's free compounding. Whatever they're giving you, those dollars, they're immediately invested as soon as they're contributed to your account, right? Now, there's vesting periods before you actually can take ownership, like if you leave the company. So you need to understand that too. Whatever you contribute, you 100% own from day one. The match, the vesting schedule, you'll get it, but it goes into your account and starts earning return immediately. And that is enormous because here's the thing, our kind of podcast, people listen to it. They're also interested in picking individual stocks. One of the bad things about a 401k for a lot of people is there's not a lot of self-directed options for most people to be able to buy stock. So what people may decide is, well, my 401k kind of stinks and it's high expense ratio funds and nothing really looks that good. So I'm just going to go it alone and I'm going to fund my brokerage account because I think I can pick better stocks. That might be true, but you would have to be able to do like 25, 35, 50% better than those crappy funds to outperform the returns that you get from those matching contributions. That's before you even consider the tax benefits of deferring taxes on your gains, your dividends, and all of those things until you start taking distributions in retirement.
Absolutely. And, these days, I would say most 401ks and 403bs are decent or good, or even if it's not overall a great plan, it will have at least an S&P 500 index fund or something like that. So you could at least take advantage of that to get the match. And then if you really don't like the plan or you really do like to pick individual stocks, then do the rest of your retirement savings into an IRA, which will let you pick whatever you want. But like you said, if by not taking full advantage of the match, you're basically giving up an instant 50 to 100% return immediately on your money.
Yeah.
Because you put in whatever, $1,000, the match might be another 500 to another 1,000. That's the instant return that will then compound for decades until you retire.
The other thing that I've said to people, I mean, most of the people I talk to about this kind of stuff work in education, so there is no match. But when I've had conversations with family members, cousins, friends who are at the beginning of their careers and setting all that stuff up, whenever I've sensed hesitation to do the contribution up to the match, I always point out to think of it like part of your paycheck, like it's part of your compensation package. And I say, if your company offered you $50,000 or $100,000 in salary, would you be like, you know what, I'll do it for 80? No, you wouldn't. You take all the money. And this is part of that. That's how I always think about it.
It's absolutely true. And it's not only just extra money in your pocket today, it's extra money that will grow for literally decades and become worth 5, 10, 20 times what that match was when you first received it. So you could even think, I'm not going to take that. It's not a question of I'm not going to contribute and get that 1,000 match today. Really, I'm not going to take it and have $20,000, $30,000 when I retire.
Yeah.
I want to throw out one more thing about 401ks and IRAs as well. We won't talk about IRAs. We'll focus on the 401ks because IRAs get a little squishy when it comes to whether or not your contributions are tax deferred. So I think that's another aspect of it that sometimes we forget about. So the median U.S. household income is, I'm going to use a wide range here, but I think it's a wide range that's useful. Between $60,000 and $100,000 is probably what a plurality of American households earn, right? It's probably the largest cohort is between that versus the number below and above. And that family, the tax brackets, I think around 22% in that bucket. So what happens is if you're earning in that bucket of money and that's your taxable income at the end of the year, for every $100 that you contribute, $78 is what's actually coming out of your paycheck. So that's another thing that's easy to forget, but that is a valuable thing, right? So basically for every $10 you put in, you're only losing about $8 out of your paycheck is a way to think about it. If you start thinking that way, it's a little easier to reset your spending early in your investing career and your professional career.
Yeah, I think that's absolutely true. And that is if you contribute to the traditional 401k. I do think that many younger folks who are just starting out, who are in a lower tax bracket, 12%, maybe even some in the 22%, actually might be better off doing the Roth.
I was teeing you up for this conversation.
Well,
brilliant. You're such a genius, Jason.
Yeah. So with the Roth, right, you don't get that tax break today, but the money grows tax-free as long as you follow the rules, right? I mean, the rules are basically, you have to leave the money alone until you're age 59 and a half. and the account has to have been open for 5 years. There are some ways around it, depending on whether you're contributing to a Roth 401k or a Roth IRA. You actually might be able to take out the contributions, penalty and tax-free earlier. Of course, I don't like to emphasize that because, of course, it's better to be left alone for retirement. But for younger folks who are in a lower income bracket, actually, the Roth might be the way to go. That does mean you have to bite a little bit more of the tax bullet today. But I promise you that once you retire and you have that ability to take out that money tax-free, you're going to thank your younger self.
There's a couple parts about it. This is one that I've been thinking a lot about. I'm still a couple years short of 50, which makes me older than Jeff, which Jeff loves to point out.
Yeah,
every opportunity.
A lot older, really, is the way I think about it.
Yeah, yeah. But one of the things, the way that I've been thinking more and more about the Roth over time is, I'm fortunate. My wife and I we've earned our way out of being able to contribute to the Roth IRA. Yeah, for folks that don't know, there's a scale that once you get to a certain level of earnings, you can no longer contribute anything to a Roth IRA. But my wife's employer does offer the Roth 401k. And one of the things that we've done in recent years with the tax cut that was put into place during the first Trump administration is it lowered us into a little bit lower tax bracket. And we decided that, the bulk of her contribution still does go into the traditional 401k. So we get it's pre-tax. We do put a percentage into the Roth to add on to what we were able to contribute when we were younger and earning less to our Roth IRAs, with the idea in just really simple terms in 2 words, and that's income optionality in retirement.
Yeah. Another way to view it is tax diversification.
Yeah.
Both, so that once you're in retirement, you can look at your tax situation from year to year and say, okay, this is a year in which I might want to take more from my traditional because I'm in a lower tax bracket for one reason or another. But then there's another year, maybe you have a big expense. Maybe it's a medical expense. Maybe you want to take the family on a trip. If you took that all from the traditional, that would really send you up into a higher tax bracket. And retirement, that also could result in higher premiums for Medicare. So you're like, you know what? If you have the Roth as an option, you can instead do that and manage your tax bracket. And you make a good point here that if you have both the Roth and the traditional option at work, you can do both. You just can't, the combined amount can't exceed the annual contribution amount, but you can't do both and get a little bit of, like I said, that tax diversification.
Yeah. One of the things I've learned too is that the employer match will not go into the Roth. It always goes into the traditional 401k bucket.
Yes. Interestingly, that is now possible for an employer to allow you to put it into the Roth, thanks to some recent legislation. But because it is a complicated situation for payroll and for the 401k providers, very few employers offer that. But starting next year, you will see more of that, where you'll have the option to put the match into a Roth, but then that means the match will be taxable to you in that year. So you're going to pay more taxes that year.
The employer contribution becomes taxable income.
Yes, exactly. Because right now, for most people, vast majority of people, the match is not taxable because it goes into that pre-tax traditional, and then you pay taxes on it when it comes out.
So I want to ask about pensions, but before that, I just want to circle back really quickly to what you said earlier, bro, about how when you're starting out, especially if you don't start out with a super high income job, which a lot of people don't, it is difficult to bring yourself to contribute even up to the match. I remember very much struggling with my own savings, when I was a brand new teacher making whatever it was, $37,000 a year. But one thing that my wife did, because she has a 401k, she works not in education.
She has a real job for a real company.
That's right. That's right. What she did was, when she first got the job, set up her 401k, she did the match. She knew enough to do that. And then she just religiously every year when she would get her raise, she would up the contribution by 1%. So I think the match was 3 or 4% back when she started. The next year, 5, then 6, then 7, and just did it every year. And then before you know it, you're at the point where you're at 15% and or you're maxing out your 401k. And then, so I thought that was a smart way. I actually started doing the same thing once I got my act together with my 403b and did a similar thing. Because most times, even if you have a modest pay increase each year, that change of percentage at the worst nets you out at like no raise. But even most times I found it, you still get a little bit of a bump even with that increased contribution. So I wanted to come back to pensions because, when we had Dan Otter on a few episodes ago, we talked a lot about 403bs, but we didn't actually talk a lot about pensions. I know they're not as common now unless you are in education or, firefighter, police, things like that. But I'm curious the way you think about if you are someone who is in a profession that has a pension, do you think they should think differently about how much to save, in what type of fund to save, and all that?
I would say it depends on the pension provider and how long you plan to be working for that company. So I also began my life as a teacher. So I worked long enough, for 5 years to get a pension. It will be so small and so negligible that I don't even think about it. I don't even factor it into my plan. But if you are confident you will be staying within that profession, or maybe if you're older and you already have a good 10, 20, 30 years behind you, and you are confident that the pension provider will have enough money to cover that obligation. And these days, fortunately, most pensions are well funded, both in terms of the private and the public. The good thing about public ones is they're backed generally by taxes, so they'll find some way to pay them. In that situation, it could mean that either A, you may not have to save as much, although I'm very reluctant to tell anyone that they shouldn't save. But also it could mean that you could be more aggressive in your portfolio, because a pension represents a huge holding in bonds, really. And what it will do for you in retirement is the same thing that a bond would do. It ideally will hold up when the stock market is down, although that wasn't the case in 2022, but most years it is. And it provides a regular stream of income. So it adds diversification to your household finances. So it allows you to be a little bit more aggressive in your portfolio, even up to and including retirement, assuming that the pension and Social Security, everything will be covering most of your expenses.
Yeah, I would assume that if the pension is robust enough, and like you said, with Social Security, there are probably some people who can just live off of that and don't even need to touch any additional savings they might have in a 403b or an IRA until you have to take required minimum distributions.
Yeah, there's no question. I mean, as teachers and former teachers, we know that you had to learn to live on what you were being paid anyhow. So you didn't have a high cost lifestyle to begin with. Then you get those other benefits, and you're gonna be pretty set, especially when you add to the fact most people, when they retire, only need about 70% of their pre-retirement income, because your expenses drop. You no longer have to pay Social Security taxes. You're no longer contributing to the 401k or 403b. Some work-related expenses go away. So you just don't need as much income as you did when you were working.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
I do have one more pension-related question, because this is one of the things, because I have a pension, so I'm relying on that. I've tried to invest as if I don't have a pension, because I live in New Jersey, and I saw when we had one particular governor who completely changed the whole system and really screwed a lot of the younger teachers, if I'm being honest. I was lucky enough to be far enough into my career that I was grandfathered into the old system, but the calculus I stepped into the profession with in terms of the compensation package is much different than it is now if you are a new teacher. But one of the ways I've thought about pension income for me, because I have tried to invest and my wife has her 401k, is could my pension income serve the function of the cash that I hear a lot of people in retirement say they keep out of the market so they can weather a downturn, right? I've heard people say, I keep whatever, 3, 5, 7 years worth of what I need, my spending in cash, so that when we have a 2022 or something like that, they don't need to be selling, stocks at losses. Do you think pension income for people who have it could serve that purpose of being like that cash, rather than having 5 years of savings in cash, just relying on that cash income? Is that a way to think about it?
It could be, depending on what you touched on, and that is the reliability of the pension, right? So if you are older and you're very confident of the amount you will get, and you're very confident of not only the safety of the provider, but you're pretty comfortable with the formula. Like, okay, I can be pretty confident that when I retire in, say, 3 years, this is the amount I'll get. The 3 to 5 to 7 years in cash is something that we call the income cushion. And I portray that as the amount you need from your portfolio. If you need, let's say you're going to get 40,000 from a pension, 20,000 from Social Security, but you need another 20 from your portfolio, it's that 20,000 times 5 or so, the cushion I would want. Now, if you need 80 and your pension and Social Security are going to provide 80, then no, the pension will actually, you don't need that cushion anymore. And related to that, I think it's really important with retirement to distinguish between your essential expenses and your discretionary expenses. To the extent that your safer sources of income, Social Security, pension, maybe a bond ladder, covers your essential expenses, then you could take a little bit more risk with your discretionary expenses, so that if we're ever in a bear market for stocks, you can like, okay, that part of my portfolio is down. Maybe I won't take a big vacation this year. I'll wait till that recovers, and then I'll take the vacation.
What's the point of retiring if you can't just do the vacation, though? I mean,
I'm constantly vacation.
That's what the point of retirement is. There's some interesting studies out there that ask workers, what do you plan to do in retirement? And then they have a list of things, right? Like travel, spend time with family, learn new hobbies, all that stuff, do volunteer work. And then they take the same question and ask retirees, what do you do in retirement? And it's basically like, I don't do anything, and I'm perfectly happy not doing anything.
It's that transitionary period, right? Where we're trying to figure out, what are we going to do? And so many people self-identify with their career and their work, that it's scary, right? That transition is definitely a scary thing to make.
Depends too when you do it, right? If you're in a profession where you can retire on the early side, that's a lot of time to fill, and you're still, young and energetic, and, versus if you decide to work till you're 80, that might be a different calculus.
Yeah. As you two know, we at the Body Fool do something called Fool 24. And I did a little presentation on this, basically. Like, is retirement good for us? And the evidence is actually mixed. For some people, it's the best thing that ever happened to them. For other people, they felt adrift. They actually became somewhat depressed, became more isolated because they were used to interacting with their colleagues. But one of the comments to the presentation from one of the viewers was, I was a teacher for 30 years and I retired and I am bored. I'm bored. I did all the things I wanted to do. I did the pickleball. I did the trips, but my colleagues are still working, so I have nobody to hang out with. I have no reason to really get up and get moving in the morning, and I'm just really bored. So it is important to determine, like, what is it about retirement that is appealing to you? What is it you really want to do? And maybe you can do it and still work, but maybe just work part-time, phase into retirement, so you have kind of the best of both worlds.
Yeah, so my parents retired with pensions. One was an educator, one just worked in schools and had that pension. And my mom was the one who it wasn't a teacher, but had the pension. And she retired probably 57-ish, right? She could go at 55. She worked a couple extra years, and she's not a sit still kind of person. And she spent the next 10, 15 years basically doing as many different things as she could, like taking part-time jobs, volunteering. And I think now that she's, a decade and a half past that, she's happy to just take trips and relax a little bit. But that's, because she's a decade and a half older. I think for people in public pensions, like teachers, firefighters, police, things like that, where you can go on the earlier side, you really do have to think about what you're going to do to fill your time. Unless you are the kind of person that's perfectly happy just sitting on the couch all day. But I don't think a lot of people in those roles are.
So we've started transitioning our show already, because we're just so good at those kind of things, into talking about you've got a foot in retirement or you're very, very close to it. But one last question, bro, that I did want to ask. for younger savers. So we've talked about matching out you're maxing out your 401k to get at least the match. Your target being saving 15% of your income is the number that experts say that should get you to your financial goals. We've talked about 401ks, Roths, traditional. One thing we really haven't talked very much about that I think is important is thinking about cash, both as kind of like real world safety net savings, but also thinking about in a diversified investment portfolio. Again, because thinking about the listeners of this show, the younger listeners are probably found us because we do talk about stocks and investing a lot. But one of the things that I've gravitated to over the past couple of years is interest rates have gone up, and I've started to transition my portfolio more towards like getting into that kind of glide path closer to retirement, where now I own 10% bonds, 10% cash, and then the rest in equities.
Because you're so much older than me is why you have to do that. I just wanted to point that out again. Go ahead.
Right on time. But thinking about younger investors, again, I'd like to hear your thoughts on holding some cash in the real world for emergencies, and what's your thoughts about kind of building that out in percentages or numbers. But then also inside those investment and retirement savings accounts, what purpose do you think cash serves, if any, and how should most investors be thinking about it in terms of an opportunistic tool versus a risk of underperformance?
So I'll just start with the classic advice that we often give is any money you need in the next 3 years or so should not be in the stock market. So for that, it could be maybe you're saving up to buy a house. Maybe you're saving up to buy a car. Maybe you're saving up to go back to graduate school. So anything like that, cash is the way to go. The emergency fund, so the classic advice is to have 3 to 6 months of must-pay expenses in cash. And part of that in a high yield savings account in cash. So part of that is that way you know it's going to still be there if you need it. And it's not in an IRA or 401k, because if in many cases, if you try to take money out of those accounts before you're 59 and a half, you'll pay taxes and a 10% early distribution penalty. And I do think it's important to think about the emergency fund because the job market is clearly slowing down. Right now, I live in the DC suburbs of Northern Virginia. I'm surrounded by federal employees who at one point thought they had a safe, secure job, but now they're not working. And who knows whether they're still going to have their job or even when they're going to get their next paycheck, depending on, what part of the government they serve. So I do think everyone has to have some sort of a backup plan so that if something happens to their job, they can pay the bills, they can pay the mortgage, they can pay the rent, they can pay the car payments until they figure out something else. Now, when it comes to retirement savings, if it is someone in their 20s and 30s, history says that the stock market is going to outperform cash and bonds.
And it's not even going to be, it won't be close.
Won't even be close.
Yeah.
So there, you would still possibly look at cash, though, as somewhat of a volatility dampener, because there are many people, especially if they're newer to investing, that they think, oh, of course I have the risk tolerance to see my portfolio go up and down, but maybe they won't. And I do get a little worried about anyone who has started investing in, say, maybe the last 10, maybe even 15 years, because we have had the market drop 20% or so, but it didn't last very long, right? Earlier this year, 2022, the pandemic panic. So there's this idea of, look, all I have to do is just hold on. But for someone like me, who started investing before the dot-com crash, where we saw the market go down in 2000, and then 2001, and then 2002, where it took 5 years to get back to where it was, or the Great Recession, which the market dropped even more, but it was
wiped out that recovery. Yeah.
Yes. Yeah. So in those situations, you might want to have a little bit more cash. We often call it either dry powder or you use the term optionality, right? Let's say there's a company you're following and it all of a sudden drops to a price that you're like, holy cow, how could I not buy more of this stock? Well, you can't unless you have cash. So that's another way to think about it.
Yeah, I like the idea of, for investors who are just gung-ho and sure that they can take on all the volatility in the world, maybe having a little bit of a hedge there. As the esteemed investor Mike Tyson said, no investing plan survives getting punched in the face.
Yeah, that's a direct quote, I think.
Yeah.
Yeah. If it does, it's hedge fund, so I know.
let's jump ahead to the end of, or, you know, the end of the working career as you're approaching retirement, because this is something Jason and I talked about a year ago, and he referenced it a few minutes ago, where he saw the retirement light, you know, far at the end of the tunnel, and started to make some tweaks to his own portfolio where he just increased his bond exposure, nothing crazy. But rather than do it all at once, I think the strategy was to do a little bit now and in perpetuity between now and when he needs that money to retire on. So I'm curious, bro, like if you have an age in mind where you know, like, okay, this is where I at least plan on retiring. And I know I've heard you talk a lot about how a lot of people end up retiring earlier than they think because of, you know, getting sick or getting injured or something like that. But let's just say, you know, let's just say you're our age, Jason and I, between 46 and I don't know, really close to 50, whatever Jason is. And you're thinking, okay, 65 is when I think I want to be, you know, in retirement, collecting money out of my retirement
Let's do
accounts.
67 because that's the full retirement age for most people.
Okay,
our age
67
for Social Security. Let's go 67.
All right, 67. So my question is, how far before that do you think people really need to start thinking about, okay, should I have more bonds? Should I start building that cash cushion? Do I have too much stock exposure? I know you probably should call a professional, have them look at it, but there are any guidelines, like as you approach, of when you should start transition?
So for me, I would say once you're a decade from retirement, that's when you need to really start thinking about it. You're in a situation where over a decade, the stock market is likely to make money, but not guaranteed. Plus, you don't want to get to a situation where your plans are waylaid because of a bear market right before you want to retire.
You don't want the market dictating your retirement plans if you can avoid it.
Right. And as you point out, Jeff, studies show that people end up retiring a good 2 to 3 years sooner than they really thought. So for my plans, I do hope to work till 67, maybe 70. But my plans are always to age 65, just in case. And it could be health issues, or it could be you think you're going to love your job, but you actually get to that point and you're like, you know what? I'm ready to stop working.
Well, that's a health issue too. You're sick of work.
Ding, 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 ding. Outstanding. So within a decade, I would say is a definite time to really start thinking about it. If you're a little bit more conservative, you might want to do it a little sooner. But in that decade is when to start thinking of what Jason is doing. You start gradually de-risking your portfolio through various things, like maybe every contribution to your 401k or an IRA, there's a little bit going to cash and bonds. Maybe you stop the dividend reinvestment from your stocks. Instead, put that into cash and bonds. It might be just a regular old rebalancing once a year, maybe taking 5% or so from stocks and putting it in cash and bonds. You do that over the course of several years, you'll get to that point where ideally, before retirement, you at least have 5 years worth of portfolio provided income in a safe space so that if there is a bear market right before your retirement, it won't completely change your plans.
So when I hear you say, you know, transition to cash and bonds, that's a big bucket of things you could actually do, like in the logistics of doing it. Like you could buy individual bonds, you could buy bond funds, you could buy bond ETFs. So I'm curious if you could go a little deeper into that aspect of it. And I'm asking you to do this and not Jason, because when Jason talks about bonds, I fall asleep.
I'm not sure I'm going to make it much more exciting. First of all, the thing to understand is you may not have many choices, right? Especially if the money is in your 401k or 403b. Your only choice may be, one cash option, it would be 2 bond fund options. So that might be just what you're stuck with. And let me just say, as a tangent here, I've written many times in the past about how the Motley Fool 401k was horrible when I joined the Motley Fool.
That's the height of irony.
I know. Well, when I joined the Motley Fool, it was 1999.
Back then, everybody's 401k was horrible.
Yes, we're a small company, only 6 years old, and back then in particular, it was very difficult for a small company to get a good plan
because the big good providers weren't available.
They weren't.
They were small businesses. You were working with brokers that relationships, big fees, actively managed stuff. Yeah, all that stuff.
Exactly. But there's no reason these days to have a bad 401k or a bad 403b. You should be advocating to your HR department, to your boss, because they're in the same boat you are in many situations. And one of those things you might be able to advocate for is the side brokerage account, which will allow you to have choices of individual stocks, individual bonds, ETFs, mutual funds. So that's my side note about that. Now, generally speaking, when it comes to historically, bonds outperform cash by roughly 2 percentage points a year. So that doesn't sound like a lot, but you compound that over a couple of decades and it's meaningful.
It's roughly inflation over the past 50 years.
Yeah. So for diversification purposes, right, where you don't need the money on a certain day, you're just adding diversification to your portfolio, I think bond funds are great. They're low cost, they're diversified, you can easily reinvest the interest or dividend, technically dividends, but it's coming from interest, back into the fund. Very simple. Once you're getting to a point where you're closer to retirement and you're saying, you know what, I want this money that I'm investing today to be available at this specific amount on my first year of retirement, and then there's a certain amount you want your second year retirement, and then your third year of retirement. That situation, I think it makes sense to buy individual bonds, maybe individual treasury inflation protected securities, otherwise known as TIPS. Could even be CDs, but something where you are investing the money, you know exactly how much you're going to get back, assuming the issuer is still in business, and you know exactly how much interest you're going to get, because that will give you a lot more certainty about your income in retirement.
Well, I think there's something about bonds and the environment that we're going through that is really, really important, because you mentioned earlier 2022, and for decades, bond funds have been ultra safe and they've been great. And I think there's an argument to be made that we really have gone through two black swans as investors since 2020. We went through the pandemic, which of course was completely, unexpected. And of course, the governments around the world, central banks propping up global economies, made that a nothing burger in the long run. You could say maybe created a bit of a stocks bubble. But then the response to that from central banks, ripping interest rates up to levels that we haven't seen since the 80s, was the next black swan for millions and millions of largely older investors, but also, some pension funds and things that had large investments in bond funds or held lots of bonds that they were regularly transacting in those bonds, because that inverse relationship between interest rates and bonds, bond values are still down from where they were in 2021 because interest rates are so much higher on those than they were back then. So those bonds that were issued before then lost a tremendous amount of value as interest rates went up. And there's a lot of investors that look in their 401k and look at the bond fund now, and it still has less value than it did 3 or 4 years ago. So I want to talk about the difference just briefly, because you mentioned buying individual bonds and building a bond ladder, and the difference between the mechanics of owning a bond fund and owning a bond when it comes to risk.
So let's just start with an individual bond, right? You're basically loaning money to a government or a company. You say, I'm going to give you $1,000 for 5 years. You're going to pay me 4% every year. And after those, 5 years, I get $1,000 back. And it's just like CDs, right? Very simple. Now, the price of that bond is going to go up and down in value depending on interest rates. As you point out, the price of bonds move inversely to interest rates. If it's a corporate bond, it might also go up and down depending.
We're going to assume the company's in perfect financial health. There's not anything about the business that makes the bond risky.
Right. So then it'll just be interest rates. That's it. So you'll look at your portfolio statement and you'll say, oh no, my safe bond is down. Well, it doesn't matter as long as you hold to maturity, because then that bond eventually will get back to $1,000. It will mature. You'll get your $1,000 back. If you own a bond fund, the manager of that bond fund is going to be buying and selling bonds all the time. In many bond funds, there's actually higher turnover than in stock funds. And that's partially because of the way the bond market works. It's partially because, let's say you're buying an intermediate term bond fund. Well, it can only own intermediate term bonds. So once an intermediate term bond becomes a short term bond, they have to sell it. So there's all kinds of dynamics going on there. But it basically means, I don't know what that's going to be worth in 5 years. And as you point out, I think if you look at the Vanguard Total Bond Market ETF, it's still down from where it was 5 years ago, because a bond fund doesn't mature. You don't know what's going to be held in there. Now, I will say there's a middle road with what are known as defined maturity bond ETFs or target maturity bond ETFs. So let's say you're going to retire in 2030. You buy one of these defined maturity bond ETFs that has 2030 in the name, and it only owns bonds that will mature in 2030. So it'll go up and down depending on what's going on with interest rates. but it will get back to roughly its NAV, net asset value, which is the share price of an ETF, in 2030, assuming all the issuers are still in business. So that's a good compromise, provides a little bit more certainty than a regular bond fund, but it does also provide the instant diversification, because going into the bond market and trying to buy individual bonds, there's a bit of a learning curve there.
Right. It's one of the things that most people are probably better off paying that expense ratio to a fund manager to outsource that work. I think that's probably fair for the most part. I do want to point out too that we are in a different environment than we were before, where we went from 0 interest rates to interest rates we hadn't seen in 4 decades, to where we are now, where rates have come down a little, but they're still relatively elevated to what we've seen over the past, quarter century, but starting to head down, which means that while the yields will drop for new issues and for, money markets and things that are tied to, current interest rates, the value of bonds is actually likely, again, inverse correlation, the value of bonds is actually likely to get a little bit of an uplift. So that risk, while the risk is always there because there's always something that can make interest rates go up, the probability seems like it's fairly low, and then investors are probably more likely to get tailwind from interest rate, the Fed's policy, than what we went through back in 2022.
Yeah, I think that's very likely, especially with shorter term bonds, which tend to be a little more sensitive to whatever the Federal Reserve does.
Yeah, you look at the 10 years and they're already baked in with longer term rates.
Yeah, and the bond market is actually bigger than the stock market, and the owners of bonds are from all over the world. So they will be buying and selling bonds for their own reasons, irrespective of what the Fed does. So on the longer term bonds, the market might have more to say about what happens than the Federal Reserve. But certainly the odds are that rates are going to come down. But for me, I always hedge on both sides. So that would mean locking in current rates for a little bit with CDs, maybe individual bonds and some bond funds that you expect the price to go up, but also having some things less sensitive to interest rates, just like plain old cash, because we don't know. There could be something that happens. Inflation could take off from here due to tariffs or whatever else, where interest rates go a completely different direction than we expected.
Yeah, I lived this exact bond fund thing because in 2020, I finally got out of my really crappy high fee 403B plan and into a participant directed one with a different vendor. And I put I just did 4 Vanguard funds, and 2 were stock funds and 2 were bond funds, and mostly weighted towards stocks, considering how much time I still have left to invest. And I think now, 5-ish years later, the 2 bond funds are almost break even. I've been contributing to them every paycheck, obviously, but it just, I had bad timing to open up those bond funds, but hopefully the next 5 or 10 years are a lot better.
Jason just described it as a black swan event, and it's true, right? There's no question that this period, particularly 2022, the worst year for bonds in the last 50 years, and by some measures, the worst year for bonds in U.S. history. Mm-hmm. It was a unique event. Hopefully, it will not be repeated again. Rates would have to skyrocket again for that to happen for the next 5 years. But I think the lesson,
or the federal government default on its debt, but we won't talk about that because this is not a political podcast.
But the lesson here, of course, is, to use a Morgan Housel quote, things that have never happened happen all the time.
Yeah.
So if you would have said to someone, a financial advisor in 2020, Jeff, as you were deciding to put money in a bond fund, look, I'm worried that in a few years, this bond fund will drop more than 10%. That financial advisor says, that's not going to happen. Look at the history of this bond fund. It has never happened before. You have nothing to worry about. But of course, that's what happened in 2022.
Yeah, but the whole, it's a hedge against stocks, moves in the opposite direction, balances out the risk. That did not happen for me.
Yes, and that's another argument for individual securities, but also cash, because cash held up and did better because interest rates went up and we finally got a return on our cash. So
not a Bank of America, but that's another
Well, that
conversation.
is a very important, like cash, just sitting around doing nothing. You should be able to earn at least 3% on your cash nowadays. If you're not, you should go shopping.
Yeah, for sure.
Jeff, I know you wanted to talk about stocks a little bit for people that are closer to or in retirement.
Yeah, and this is maybe my last question about thinking about the retirement aspect, the being in retirement aspect of this conversation. And that is, we hear a lot about the 60-40 portfolio, 60% stocks, 40% bonds in terms of getting yourself to retirement. Again, didn't work out so well for me over the past couple of years, but we won't go back to that again. I'm curious, bro, you're thinking about holding stocks in retirement. You don't hear much talked about that, but I think a lot about the fact that I'm having so much fun building this individual stock portfolio, and the idea that like one time at some point I'll just sell it all and turn it into bonds seems depressing to me. So I'm curious your thoughts about holding stocks in retirement.
Well, you should most definitely hold stocks in retirement because you have multiple risks in retirement. Now, you have short-term volatility, which can be very damaging to retirement because you're selling a little bit of your portfolio every year. So that could be damaging. But you also have to make sure that your portfolio keeps up with inflation and lasts as long as you do. And you need money in stocks for that to happen because you may be retired for 20, 30, 40 years. I love the work of Bill Bengen, the father of the original 4% rule. He came out with that in 1994. He has since revised it many times, including in a recent book that just came out this summer. The 4% rule, by the way, now is 4.7%, and that is the bare minimum. He said in an interview with me that he would maybe do 5.5% nowadays. But what he also looked at in his research is what's the optimal stock bond split to sustain a good withdrawal rate in retirement. And in his book, he settled on 55% stocks, 45% bonds, cash. But as he told me in the interview that I did with him, 5 weeks or so ago, he said, additional research he has done, he said maybe 65% is actually better. So it's one of those situations where you should have, I would say, at least 50% of your portfolio in stocks because of the risk of not having enough in there. The safe withdrawal rate based on Bill Bengen's research, once you get to below maybe 40% stocks, the safe withdrawal rate drops considerably. Like it just doesn't sustain as much of a retirement because it's just not going to keep up with inflation and last long as you possibly could.
Just to break down the math of the 4% rule for folks that don't know exactly how it works, because you don't take 4% out of your account every year. And so we could use the 5.5% as his latest thinking on that. And correct me if I'm wrong, but essentially the way that works is your first year of retirement, you would take 5.5% of your retirement assets as your distribution. You would take that out. And then every year after that, whatever that dollar amount that you took out, you would take it again plus inflation, right? Cost of living increases on top of that. And that would basically give you that dollar amount that you would need to cover your expenses in retirement in perpetuity.
Yes, that's exactly how it works and as originally conceived. You only use it in your very first year of retirement. Then you throw it away and adjust that dollar amount for inflation. Nowadays, there are more sophisticated strategies, more dynamic strategies that basically allow you to take a little bit more when your portfolio is up, but maybe cut back when your portfolio is down. Because that's what happens in real life with retirees. They basically change their spending based on what's going on with their portfolio. Plus the way that's originally conceived for the 4% rule, that you need your income to go up every year for inflation, actually isn't what happens for most retirees. Most retirees, their spending actually gradually goes down as they get older. They don't do as much. They don't buy any more furniture. They don't drive as much. They might pay off the mortgage. Sadly, a spouse might pass away. So they actually don't need their income to go up every year with inflation, which means in your first year of retirement, in your first maybe 5 years, you could actually take out a little bit more. Enjoy it while you can, because you probably won't need as much as you get older, other than at the end when you have more healthcare expenses.
I just have one more random question. When you're forced to take required minimum distributions, if you don't need that money, can't you just put it right back into stocks and bonds?
Yes.
Okay.
Ends at age 73, although it'll move up to age 75 for those who were born in 1960 or later. And it only applies to traditional accounts. So that's another benefit of the Roth. There are no RMDs with Roth accounts. If you don't need that money, the money will come out. It's added to your taxable income, and then you can just buy anything else you want once it's out. And depending on your financial services provider, you can take the distribution as the security. So you own, I'm just going to make up Apple stock. I don't need to sell it. I don't want to sell it. So I'm going to take my distribution as Apple stock and have it just sit in my regular taxable brokerage account. You still owe taxes on the value of it as it came out, but you don't actually have to sell it. Now, there's no big deal, right? You could sell your Apple stock. There's no brokerage these days. If you're paying a brokerage to sell or buy stocks, you're in the wrong place. You can sell Apple stock, comes out as cash, you buy it again. But in the course of those few days, you were in it. And what if something really good happened? Also, you may own something that is a little less liquid. For example, individual bonds, especially individual corporate or municipal bonds, aren't always that liquid. I'm like, oh, man, I'm forced to sell this and I want to keep this bond. You can take that as the distribution and just hold it in your taxable brokerage.
Interesting. That's good to know. I'll try to remember that in 30
Call me
years from
up. I'll still be working.
Bro, this has been great and hopefully useful to people on both ends of the continuum of your working career and saving up enough so that you can retire and do absolutely nothing when you get that illness of being sick of work.
What happens if you have that like way before retirement? That's a different podcast, I guess.
You go on a sabbatical.
There you go.
At sabbatical, you think of another job that you've always wanted to do, because there, you probably don't need as much income, especially if you had kids and they're out of the house. Maybe you've already paid off the mortgage. You're in a situation where like, I don't want to retire. I maybe even can't retire, but I'm tired of my job. It's a whole new opportunity to do something you enjoy where you might have a little bit more economic freedom to do something that doesn't pay as much income. But if you enjoy it, you can do it well into your 70s or 80s.
Yeah, and that's the best work in the world to have right there, is work that you want to continue to do. I want to continue doing this podcast with you until I am 94 years old.
I was just going to ask when I get to retire from this, but now I feel bad because you said something so nice. So
I was setting you up. The whole thing was a setup. Bro, again, it's awesome having conversations with you. And we'll try not to wait almost 3 years before we have you back on.
I would be happy to come on anytime you want me.
That's awesome. Folks, I want to remind you to check out Bro's work at The Motley Fool. He does a lot of work for members. What is it? Game Plan, I think, is the latest name of the... Go ahead.
Yes, Game Plan. That's the premium service where I do a lot of writing, but I also do the Saturday episodes of the Motley Fool Money podcast, and that is absolutely free.
Yeah, and definitely worth putting on your list to check out that. We'll put a link in there for that podcast as well. And it is definitely do the Saturday ones. I'm usually there on Tuesdays. You don't have to listen to those.
Yeah, skip Tuesdays, go for Saturdays for sure.
Yeah, for sure. All right, cool. Okay, bro, again, thank you so much for coming on. We'll have you on again soon.
Such a pleasure. Thanks, guys.
Thanks, bro.
Is that it? We're done?
That's it. Wrap it up.
Okay. All right, everybody. We're done. We're done giving our answers. Bro's done giving his answers. I'll make an exception and say that Bro's answers can probably be your answers, people. But you still need to make sure. You need to make sure they're the right answers for you wherever you are on that continuum of saving for retirement, investing, financial planning. You can find the right answers, though. I believe in every one of you. You can do it. All right, Jeff, we'll see you next time.
See you next time.